Hello, I'm Alex Davies, founder of Wealth Club. Today I'm with Bill Nixon, managing partner at Maven, to talk about the Maven VCTs. Bill, tell me about the Maven VCTs. What do they aim to do for investors?
I think it's a combination of things, Alex. First of all, VCTs are obviously very attractive because of the inherent tax breaks. But what we try to do is give investors a combination of steady capital growth as NAV increases year on year, alongside an attractive flow of dividends.
And give me some background about Maven and yourself.
Maven was formed in 2009 after a buyout from Aberdeen Asset Management PLC. We've actually just celebrated our 10th anniversary, so we've now been in business for 10 years. I've been a VCT fund manager since 2001, so approaching 20 years. And I've seen the industry change in all the iterations of the rules, particularly the changes in 2015, which now directs managers towards younger, earlier stage growth companies.
Okay, and how much are you looking to raise and what are you going to use it for?
We're looking to raise a smaller amount this year, 15 million, which is 7.5 million per VCT. And the fundraise is effectively intended to further scale the VCTs as they grow every few years. And I think now that the VCT industry managers are focused on younger companies, having larger VCTs with greater scale and greater portfolio diversity is a good thing.
So you're opening VCT 3 and 4. Why those VCTs, and are they different from the others in any way?
Well, those VCTs haven't raised money for some years. So generally our client VCTs, we raise funds in a cycle. Last year it was Maven 1 and 5. This year 3 and 4 are raising funds. They've been investing very actively over the last 2 and 3 years. So it's about replenishing the funds that have been deployed and further scaling those VCTs.
So let's talk about the investments you make. What are the characteristics of the companies you're looking for?
I think the key characteristics, Alex, are the people. I think, as you're aware, the VCT rules changed in 2015. Prior to 2015, we were principally focused on buyouts. Now it's younger, growth, fast-growing companies. But the fundamentals haven't changed. It's all about backing the best people. So we're very focused on the people. We're very focused on companies that are disruptive, often an overused word, but companies that can make a significant impact on a certain sector. And we believe that the combination of good people, capital, in a market that is ripe for disruption can be a compelling investor proposition.
So let's talk about the portfolio. What's its current composition?
Composition of the portfolio is currently broadly 50-50, legacy private equity and new private equity. And that is approximately half the companies were invested in prior to 2015. And these are older, larger, more mature businesses. And that blends nicely with the younger portfolio. These are younger, faster growing companies, mainly invested in post-2015. So roughly 50-50. And actually both VCTs have a similar composition of portfolio between legacy and new. Both of them also have a small AIM presence. That's a market that we are also active in alongside private equity.
Let's start off with the legacy portfolio. Can you give me a few examples of what's in it?
So there are 2 legacy companies in the portfolio that I'd perhaps like to highlight. One is Global Risk Partners, which is a Lloyd's of London specialty broker. It's been a consolidator in that market, which has been ripe for consolidation over the last few years. That business is led by a very senior team with many decades of insurance experience. And that business is now in the top 10 in its market in the UK. And also a completely different type of business in the oil services sector, Armec, which is a business in Scotland, which is principally a rental and service business, which, like many oil service companies at the time of the downturn, suffered, but has now recovered very strongly. And that business is trading very well at the moment.
And should we talk about some of the recent investments you've made?
Well, obviously the newer investments have to comply with the post-2015 rules. 2 investments perhaps I'd like to mention. One is Delio, which designs and builds white label platforms for investment banks and wealth managers. And secondly, Relative Insight, which is a linguistics platform based in the north of England and a transaction led by our Manchester team. Two PhDs started that business. It's now got very significant commercial traction, and it helps a number of corporates such as Unilever and Disney with its customer proposition in different jurisdictions.
What about exits? Have you had any this year?
We've actually had two very good exits in the last few months. GEV, based in Hull, which was a business we backed a few years ago, which is one of the world's leading maintenance companies for the wind turbine sector. It's internationalized, it's expanded into the US. We got to a point where the management were seeking an exit and a larger private equity partner. We ran an auction for that business, and we sold the business to a secondary private equity fund manager for 33 million. That delivered a return of 2.7 times. And more recently, Just Trays. Just Trays was one of the UK's largest independent manufacturers of shower trays based in Leeds, and we sold that business to a trade consolidator, generating an investor return of 2 times capital over the holding period.
And is there anything not gone so well?
I think, as I've said to you before, I think where you have a large portfolio of private companies, clearly things don't always go to plan. I think one thing that we've learned post the rule change is that we've seen a few very early stage businesses led by entrepreneurs with very good CVs, and it takes much longer to get commercial traction from startup. So I think we would probably avoid very early stage. We're really now looking for businesses with meaningful revenues of $1 million plus. I think also any business that's hugely reliant on pay-per-click or Google Ads. I think the combination of startup and excess capital to be deployed in that type of marketing can be punitive for a very young business.
Keeping on the new rules, how do you think this is going to change the risk profile of your VCT as you get more new investments? What should investors expect?
I think there is no doubt that the risk profile of VCTs is going to alter, and the managers are now making higher risk investments. However, at the same time, many VCTs, such as Maven 3 and Maven 4, are growing in size, they're scaling up. And what that means is that the portfolios will be larger. So although the financial risk at company level will increase, portfolio risk may decrease because the VCTs have a much larger number of companies in their portfolio.
And should investors really expect lumpier returns?
I think if you look at VCTs prior to 2015, I think total return NAV and dividends were more predictable. I think post 2015, as we're building larger portfolios of younger, earlier stage companies, I think that's inevitable. I think it takes longer for some of these companies to come through an exit than it does with buyouts. And I think what that means is that yes, investors should expect spikier returns and dividends may be less predictable. But the key thing is to build a larger VCT and a larger portfolio of companies that should help spread the risk.
And are there any differences between the two VCTs? Should I choose one rather than the other?
I think both Maven 3 and Maven 4 are very similar VCTs. Both have roughly 50% in legacy investments and 50% in post-2015 younger companies, which provides a nice blend of investments to investors. And there's also AIM in there as well. The other key point around AIM is that we are one of the few managers who have a hybrid offering around private equity and AIM. And that allows us to trade our AIM portfolio much more actively. We're able to invest in AIM, qualifying in AIM investments alongside our private equity portfolio. And unlike sole AIM managers, we're able to top slice AIM investments when liquidity permits. So I actually like the model, the hybrid model of having private equity and AIM, as I feel it gives investors access to two very different asset classes.
Are they investing in exactly the same way, both these two VCTs?
Yes, both VCTs are investing similarly relative to their NAV, so both will be investing in the same private company and AIM investments.
So finally, Bill, I've got some money to invest this year. Why should I put it with you?
Well, Alex, the two VCTs that are open this year are long-standing, substantial VCTs. I've been the fund manager of both VCTs since inception. Maven VCT3 was formed in 2001, so it's almost a 20-year-old VCT. Their combined NAV is almost 100 million, so they are significantly scaled funds. We have one of the largest teams in the UK. We're completing around a dozen new investments for investors each year. So the portfolios are building, they're broadly based, and investors have access to a manager with a genuine UK presence who's completing a large number of interesting transactions. We're not a UK, or rather a London-centric manager. We're very focused in the regions, so we tend to give investors access to something slightly different.
Bill Nixon, Maven Capital Partners, thank you very much.
Thank you, Alex.